Okay, all right. So that's the UltraTech numbers which are flashing on your screen. The net profit has in fact come in lower than what the anticipated poll was indicating. So the net profit has come in at around over 825 odd crores versus our poll of around 939 odd crores. So we were any which way expecting a profit decline, but the profit decline has come in steeper than what was anticipated. So it's an easy over 30% decline which they've reported in terms of the profit this time round. Well, when it comes to the revenue, we're waiting by. We are expecting it to probably be a decline in terms of the revenue as well. So 15,635 odd crores is where it's coming at. Our poll was 15,420 odd crores. So there's a decline which is coming. It's a bit better than expectations. I assume that maybe there could be some amount of margin pressure which is probably filtered down onto the profits, and that's the reason why you're seeing this kind of mismatch where the profit is lower than anticipated but the revenue is higher than anticipated. But nonetheless, sales volume were expected to increase around 3.5 to 5 odd % on a year-on-year basis. We're waiting by for those details to come through. We'll have Nigel join us soon as well. In the interim, we have Manish, Valecha, who is a research analyst at Anand, Rathi, joining in on the phone line to react to the UltraTech numbers. As you can see, it is the margin which is actually under pressure. So coming at around 12.9% versus expectations of 14.14%. So that's really the key pain point for UltraTech this time round. As you can see, stock is down around 1.6%. Manish, over to you on the numbers. Prima facie, significant margin pressure.
Yes, I agree. There is a pressure, I think, but a lot of it has been already factored in. So we had another company reporting results on the weekend. I think from that perspective, there is a miss of about 13-14% from what the street was expecting. We think that this should come back pretty much quickly. There should be a blip, and we have come out from a very bad result season for last 6 months in terms of both demand as well as on the pricing front. Given the uptick in both slightly on the volume front and the improvement on cost, we think this dip would be bought into.
All right. Hi, Manish. It appears there is some benefit, though, of power and fuel costs. So on the cost side, they have got some benefit. And in spite of that, you're seeing margins coming in at sub 13%. What are you factoring in terms of a recovery from here on?
Hi, Nigel. We think there will be about a 150 to 200 rupee gain over the next 2 quarters in terms of the power and fuel front. I think the low-cost inventory on petcoke will start kicking in only in 3rd quarter and 4th quarter or so, which means that the benefits start coming in 3rd quarter onwards. And you also, it's a beginning of the construction season, so you see increase on the pricing front. That's what we think, that this should be a kind of a bottom quarter for most of the cement companies.
All right. And, we did have Dalmia as well that came out with a set of numbers. Nothing great in terms of management commentary as well, but yet the street bought into that. I'm just looking by to see, some commentary that's come in there. They are saying that the utilization levels for the past quarter was at around 68%. Domestic sales volumes grew by around 3%. So that's a bit of a disappointment. Manish, what were you factoring in terms of a volume growth? Domestic sales, the street was it was a broad number between 2 to around 5%. It's coming at around 3%.
Yeah, sure. We were looking at about 4% kind of volume growth.
So it's a little lower than
3%. Yeah, it's a little lower. On 3% volume growth, the number, I think the EBITDA should be close to 750 odd per ton, which obviously is much lower number compared to the street estimates. But, when I see the stock price, last 1 month, it has come off by almost 9% from the highs, which I think is kind of factoring in the lower number.
Got it. Stay with us, Manish. Ronald Siyoni, the Associate VP of Sharekhan by BNP Paribas, joins us on the show. Hi, Ronald. Good afternoon. Good to see you. Tell us, what is your initial reaction? The disappointment seems to have come into the margins front. It's coming at sub 13%. It's a bit of a miss in comparison to what we're working with. And on the volume front, the growth is just 3%. How much of a miss is it in comparison to your numbers?
Yeah, good morning, and thank you for having me on the show. So yes, as you said, the volume, 3% growth. We were factoring around 4.5% growth. So volume is a little bit lower than our expectation. Also, we were estimating EBITDA per ton of about 765 rupees at standalone level. And overall bottom line around 865 crores. So, yes, there is a miss. We had also seen the operational miss on Dalmia's results also. So, there is a miss initially on these two companies' results in the cement sector as a whole. But yes, all eyes are on, for H2. Q2 was expected, weak for cement. Especially we were expecting around 200 per ton, EBITDA per ton, decline sequentially for the sector as a whole. But yes, still there is a bit of a miss from the results.
All right, what do you do with the stock? It's not actually falling apart, as we speak. What is your view?
So actually, we believe that, the weak cement prices, they are for some time and they should, I think, gradually improve. It may not improve, at a faster pace because of the consolidation happening in the sector, the competitiveness happening in the sector, and also there was a weak demand in H1. But as, H2 comes and there's some kind of revival in demand and cement prices should gradually inch up. But we believe that all companies are focusing on the cost front, also power and fuel cost, the growth, the weakness in the coal and petcoke prices remain a tailwind for the sector, although marginal tailwind. But they are poised for good volume growth in the coming quarters. And valuations, as you are aware, they are above average, but near their peak, but not have reached the peak levels yet.
Okay, would you buy into the dip then?
Yes, we definitely would like to, buy in the dip, and every correction would be an opportunity for the sector as a whole, because we see that the demand outlook is not a 1 or 2 odd year scenario. It's an outlook which will be there for at least 4 to 5 years in the near-term horizon. We see this demand to remain very strong. There would be a few quarters here and there where there could be weaker volumes, and there would be an opportunity to buy in this space.
Okay. All right. And just to revise the number you were working with for the EBITDA per ton, I have what the management has given. The domestic operating EBITDA per ton as per their calculations is around 732. They're saying it's down by around 224 on a year-on-year basis. How much lower is it in comparison to what you were working with?
Yeah, we were working with 765, so around 35 or lower than our estimate. So for Dalmia also, we had a miss by about 45 rupees per ton. So there is 30 to 40 rupees per ton miss on the EBITDA per ton in both these results.
Okay, got it. All right. Thanks a lot, Manish, as well as Ronald, for joining in and filling us in with all of those details. So that's UltraTech's numbers up for you on the screen. The stock is lower by close to around 2%. The miss in comparison to what the street was working with is close to around 6% or thereabouts. It's coming at around 2018 crores. The problem has been on pricing. The volume growth as well as only 3%. Most on the street were working with a higher number. And just before we wind down, we have the net debt number as well, which has moved up a little bit. It's coming at around 8,792 crores. They've been doing some, some expansions that we know, and they've also done some inorganic growth. So that could explain why the net debt is gone, is a little bit lower. Now the stock is lower, but remember the street was bracing for a weak set of numbers. Management commentary will be crucial. Are they seeing some signs of recovery, and how optimistic are they about the second half of the year? So that's it about UltraTech, a miss on the operational front.
Absolutely. Well, Nigel, thanks very much for that. As you can see, the stock is just about moved lower, down around 2.6% for UltraTech now, reacting to what has been a miss on the margins unequivocally. And not to mention that the volumes have come in at 3% versus estimates of 3.5% to 5%, so on the lower end.